Wonderful. So I think we'll kick off. Many thanks to everyone for joining us here today. My name is Phoebe Tucker and I am a Nature Associate at the Green Finance Institute. I'm delighted to be hosting this webinar, which is actually the 7th in a series of webinars that takes nature-based projects through the journey of investment readiness as set out by the GFI Toolkit on investment readiness, which I hope everyone in the room is familiar with, but I will be posting a link in the chat. So this topic specifically focuses on identifying and working with investors. So defining the investment ask and approaching investors and what you need to have prepared. What does ongoing engagement look like, and what happens when you close the deal, and what can you expect once you've got the money in from investors? So very quickly, I'm going to make a key distinction here in that when we say investors within the context of this webinar, we're talking about repayable finance, such as debt and equity, and not necessarily buyers who are essentially paying for a service or a claim from the project. And we know that the term investment is sometimes used interchangeably on this front, but in the context of project development in particular, we think it's really useful to make those roles a little bit more distinct to figure out the flow of the money and what exactly projects are promising to who. So if anyone is interested in the buyer perspective particularly, I should note we have already hosted a webinar on buyer engagement and what can you expect with buyers, which I'll quickly post in the chat here. Very good. And so we really hope this webinar is going to be useful for those that are considering repayable finance and, you know, what exactly are you asking from investors and which investors are you approaching? On the topic of recordings, before we kick off, I'll just go over a little bit of housekeeping. This webinar is being recorded, and while this session itself is open to members and projects of the Natural Environment Investment Readiness Fund, the NERF, I should flag that this will be posted on GFI's YouTube channel on the link that I've just posted in the chat and on our Investment Readiness Toolkit. For Q&A later on, as always, there's going to be time for questions and answers with our amazing panelists, but please do feel free to submit your questions as we go along in the Q&A function or in the chat. And then also feel free to raise your hand when we get to the Q&A, because we'd love to hear from you, our amazing attendees yourselves. And with that, I will kick off this webinar and introduce our brilliant panelists. So on the Crystal Clear Cliffs project, we have Simon Bates, who is project manager at the National Trust, and Simon Drake, finance director at City Science. We have also Tom Gegg, who is project development lead of nature-based solutions at Palladium, and Tom Dyke, who is manager in the corporate finance team at Triodos Bank. He's here to talk about corporate finance in the context of nature-based projects. So we've got 2 Simons and 2 Toms on the panel, which is a complete coincidence, but I hope everyone enjoys that as much as I did when planning this webinar. So with introductions and the scope of the webinar today covered, I think we will kick off with our first set of speakers. So the Crystal Clear Cliffs project, Simon and Simon, how are you both doing?
Very well, thank you. It's nice to be here. Thanks, Phoebe.
Yeah, likewise, great to be here.
Excellent. So I'm going to kick off with 4 slides, and then I'm going to hand over to Simon Drake. So let me just start by sharing my screen. And hopefully we can now see an opening slide.
Brilliant. Yes, we can. Thank you.
Excellent. So to introduce myself properly, I'm Simon Bates, and when I was leading this project, I was employed by East Devon District Council as a green infrastructure project manager. I've just moved literally over the railway line to work for the National Trust on one of their landscape recovery schemes for nature, so I haven't gone far. And so this work is still very front and foremost in my mind. And not least because of part of the landscape recovery project, we have to explore blended finance. So this is all grist to the mill. And we were really pleased to be able to work with City Science and Simon Drake to work on the business engagement and the financial model side of this work. But this was all about an ambition to achieve 30% canopy cover in the Clyst catchment. And on the left-hand side, you've got an aerial view of the East Devon project landscape. And in the foreground there, you can see our typical landscape of mainly farmland with some hedgerows and with a lot of the woodland confined to stream corridors. In the background, you're looking at the area of outstanding natural beauty, which has got more like 25% tree cover, and gives you an idea of the sort of landscape that we're aiming to achieve. So to give you your geography, the project is down here in East Devon, just northeast of Exeter. And on the right-hand side, this rather complicated diagram, the green area, the green wash, is a policy boundary for a Clyst Valley Regional Park, as basically the green response to a lot of the development we're seeing on the fringes of Exeter, with the new town of Cranbrook and its country park, which you can see hopefully on this diagram here. So there were three principal objectives that we set out for this NERF-funded element of the project. So the first one was to calculate the strike price per hectare per year across 10 different farm enterprises in the Clyst Valley, and I'll just say a bit more about strike price in a second. The second objective was to assess the market for purchasing carbon credits. And we looked at a minimum 5 large and 10 small and medium-sized businesses in the area. And the third objective was to monetize the public benefits that might arise from 30% canopy cover, specifically looking at access or health and well-being, water quality and flood amelioration. So just coming back to this question of the strike price, what is the strike price? That is the gap between what the landowner generates presently from their current land use and what they might generate in converting that land to woodland. Essentially, it's the gap that we would need to plug predominantly through private finance to enable that change in land use to be financially viable. And my last slide before I hand over to Simon, what were the outcomes against those objectives? Well, we found out that that in our area, the strike price varied from a low of £8 per hectare per year up to a high of £647 per hectare per year, with an average of £150 per hectare per year. So this is the gap in funding that we'd need to plug, having accounted for things like the grants that are available from the Forestry Commission for woodland creation. And we found that 90% of companies were keen to invest in local carbon credits, and we got some handle on how much more they might be prepared to pay pounds per tonne above the government's guaranteed level for carbon. And that final one about monetising public benefits, we calculated these values. Again, this is across the whole catchment per year at 30% tree cover, and we might be able to realise these financial values. And of course, this is all well and good, but then you've got to actually find people willing to buy buy into these public benefits, and that is where Simon's part of the project comes in.
Thanks, Simon. Yeah, so kind of off the back of all of that work, we developed a business model or a collection of business models to ultimately achieve that objective of increasing canopy cover. And that business model focused around these kind of three-pronged approach. First is educating the landowners about the benefits, non-financial benefits of tree planting, and just kind of stimulate that kind of flow of tree planting and projects coming to market. Then a financing offering which specifically looked at the cash flow pressures and cash flow barriers of tree planting, which we'll focus on slightly more in a second. And finally, a kind of brokerage offering, recognising the fact that we identified a number of quite large buyers of kind of carbon credits in the area, and therefore an opportunity to kind of do a more bespoke matchmaking brokerage service as part of this model. So we jump to the next slide and look at the kind of finance offering. So this is kind of recognising the fact that the kind of large planting sites, there is kind of a cash flow barrier to the landowner. So we built up two central financing offerings to kind of combat that. The first is around the UK or the England Woodland Creation Offer grant. So a great scheme, that obviously pays for the cost of planting trees, but that grant can be claimed in arrears after the expenditure being incurred. There's some kind of big schemes where there's kind of a lot of upfront site preparation costs that can create a barrier. So we produced an opportunity there for landowners to get a short-term loan for up to 6 months to cover the cost of that planting until they get the grant funding coming through. So that kind of covers the barrier of actually getting trees in the ground. But then we also identified this problem where if a landowner is converting the land from productive agricultural land into woodland, is there some issues hearing me? Am I not loud enough?
Yeah, actually, Simon, if you lean in a bit, I think that's a bit clearer.
Oh, sorry about that. I'll try and speak up.
No worries.
So the second part of that was a kind of looking at the fact that those creating woodland carbon units, typically those are validated every 5 to 10 years. So there's this kind of cash flow gap of creating woodland and actually creating a return from that. So the second business model part of the kind of financing element of this was to create an opportunity where they can draw down a regular monthly payment from a finance offering, and then at a 5 or 10 year interval, they can sell those units and obviously pay back that borrowing. So it's effectively converting a kind of a longer term investment into a regular cash flow income stream. So we jump to the next slide. Obviously, to do both those, we need a method of raising capital. The project set out the ambition of looking at environmental impact bonds as a method of raising that capital. In terms of what that is, the diagram on the right kind of explains it relatively simply. So you have an investor who invests cash into a project. The project then delivers the project and ultimately the benefits of that project. So hopefully some environmental benefits in there. And then you have an outcome buyer who buys the benefits of that project. And that kind of payment from the outcome buyer then is used to repay the investor. In some cases, that investor and buyer could be the same person, or can be separate, as the diagram shows. So yeah, a great idea, but in looking at how it might actually apply to our project, the issue we found was that there were ultimately a lack of buyers for kind of non-carbon benefits in the area. So that kind of the outcome buyer didn't really exist at the scale we needed. Also, the non-carbon benefits and impact of tree planting, so the water quality, air quality, those sorts of things, were prohibitively expensive to monitor and measure on small planting sites. So at this point, we had a bit of a pivot, and we decided to actually look at another opportunity in the community municipal investment space. So for those that aren't familiar with this, the best way to think about it is sort of crowdfunding. For crowdfunding, you typically purchase a equity investment in a company or in a project. But similar in this scenario, but you're actually just purchasing or investing via a loan rather than an equity investment. So the way it works is the lending opportunity is advertised in the local community. And the nice thing about this is it can be advertised alongside the kind of project aims. You've got kind of advertising good development that's going to happen as a result of the investment, as well as the investment opportunity. Then local residents and businesses lend money to the council, typically by a kind of regulated intermediary, and the investor then receives a fixed interest return. So in terms of kind of scale, the kind of minimum level is probably around the £250,000 mark to make it worthwhile in terms of the legal and administrative costs that they're doing it. But it can raise up to sort of £7 million of capital, so kind of quite flexible in that regard. And this can also be done in a sort of a one-off event, so just raising sort of one project. But what we've kind of seen and learned for other projects is this opportunity to have kind of a regular pool of investors that will come back and keep investing in projects as they're available, so it can be a continuous sort of reliable capital raising mechanism. So that's a quick summary, but happy to take questions at the end.
Brilliant. Thank you so much, Simon and Simon. So just a quick question from me before we move on to our next speaker. I know that quite a few local authority representatives are on the call, and I was just wondering, in the context of developing local nature recovery strategies, and a lot of local authorities are, as you say, exploring blended finance. So do you think the idea of a community municipal investment holds sort of potential with those representatives?
Yeah, absolutely. I suppose it's the same with any sort of repayable finance, though. The thing that you've got to remember is that you've got whatever you're using that money to invest in terms of a project, there's got to be an income or cash generation opportunity off the back of that. So that's kind of a key barrier. But as long as you've got something that's creating a revenue stream, whether that's carbon sales or getting sort of people paying to access sites, those sorts of things, then absolutely, it's a really valuable mechanism.
Brilliant. And in terms of timings with the CMI, are you thinking about going out to external stakeholders soon and kind of putting together a more formal offer, or is something already out there? Just getting a sense of timescales, really.
Maybe I should have a go at that one. We've had local elections, and thankfully in East Devon there's not been much change, and our members are very, very passionate about tackling climate emergency and nature. So I believe my colleagues that I've left now at East Devon are going back to the members, the reappointed members, with asking them to take this project further and to do some, for example, scoping. So in my opinion, I think what would be very robust is that the woodland creation sits alongside other low carbon projects like photovoltaics on roofs, which would make for a much more powerful package, because you've got the greater deliverability and quick revenue stream of things like photovoltaics against the slow burner of woodland creation. But that's the sort of where we are. We're going back to members to get them to fund that further work.
Brilliant. That's really good to hear, and a great point on combining with other green finance projects. So thank you so much both. Tom, I believe, Tom Gegg, you're our next speaker. How are you doing?
Hi, can you hear me okay?
Yes, I can. And Rowena, thank you for calling out audio quality. I hope this is okay. I can hear you, Tom, but just checking in with our audience how the audio quality is coming across. I'm going to take silence as a yes, so.
Okay, well, just stop me if you can't hear me. So hi everyone, my name is Tom Gegg. I work on nature restoration projects at a company called Palladium. Traditionally, we've done a lot of work in the tropics on projects to stop deforestation in places like Indonesia and Brazil. And for the last 2 years, we've been working with the national parks in the UK. And we've thought quite a lot about how to really get private investment in the true sense, upfront capital costs that are repaid to the investor, how to get that to work for these projects. And I think a useful way of thinking about capital investment is that an investor could essentially invest in 3 different things for your project. They could help you, you could get investment to buy the land underneath your project. So that's basically like a mortgage, and it's not plenty of examples out there of how to buy land in the UK. And I think a lot of the big projects that have happened in the UK so far have been this model of investment. So that's number 1. Number 2 is that you could get an investor to invest in your business. So if you have set up a dedicated business to run your nature restoration project, or to run a portfolio of projects, then you could get an investor to invest in that, either via equity or debt. And they would either lend you the money, or they take a share of ownership of your business. And there are quite a few examples, I mean, not loads of examples, but a fair few examples in the UK market at the moment of developers doing this. So for example, the team that I work in Palladium, we got our investment internally from our kind of parent company, but we could have gone externally to get investment as well to do our work. And then the third type of investment is investment into the project itself. So not into the land or into the business, but into specifically the project in a particular location. And this is normally called project finance. And it's very common in other sectors. So in energy projects like wind farms or big solar parks, or in infrastructure to build bridges or buildings or roads, this is it's very common to get capital investment into these projects. And that's what I'm going to focus on a bit in here, because I think this is the model that we as a team in Palladium, we really want to prove that you could take this model of investment into infrastructure or energy projects and apply that to creating 1,000 hectares of woodland in Yorkshire or something. And the way that this normally works is that if you're building a wind farm, you would have a project developer, which is an organization in charge of designing and leading the project, and they would do all of the feasibility assessments, all of the design work, get planning permission, work with local landowners to get them on board, do all of the deals basically needed for the project to work, line up buyers, say if it's a wind farm of electricity, line up government subsidies. So if it's a wind farm, that would be from what is now the Department for Energy and Net Zero. Line up long-term lease agreements with your landowners if it's onshore, or with the Crown Estate if it's offshore. And you bring all of the pieces of the puzzle together, and you do your financial modeling, where you project all of your costs and all of your revenues over the full project period, so at least 20, 30 years. You calculate the returns that you can offer to investors. And then at that point, when you've done all of this kind of structuring and preparation work, which can take, take at least a year, if not longer. I mean, some wind farms take years to get through planning. But when you've done all of that, then you're ready to go out and raise the large amount of capital finance required to build your turbines, for example, and install them. And at that point, you go to either an equity investor or a debt investor, and equity investor would take a stake in the ownership of your project. So to do that, your project would need to have its own legal entity that they could take a share of, or debt, where they will lend you money over, say, 8 to 10 years with an interest rate. And they generally will want to see everything that you've done in your preparation. So all of your financial modeling. If it's a debt investor, they'll want to get in probably a third-party auditor to review your modeling to check that it all looks okay. They'll want to see all of your agreements with landowners and your contractors who are going to deliver the work. And they will basically check everything. And equity investors are normally a bit less stringent. They're willing to take a punt on the team, but they also want to see quite a lot of these things as well. And to be honest, doing this is really hard work. I don't think there are really any, I mean, Phoebe, correct me if I'm wrong, but I don't think there are any models in the UK of nature restoration projects that have taken this project finance model and got investment that way. I think that's where we'd like to get to eventually. So you finance woodland creation or peat restoration in the same way that everybody else finances infrastructure or energy projects in the UK. but it's quite hard to prove that, we've got to prove that it can work. And one of the big factors is, the carbon price has to rise to make these projects viable so that they can not only be profitable, but pay a return to investors. So that's what we're working on. And we'd really like to see it work eventually, because this is how we think investment into the sector will really scale up. So it's not just buying land or investing in businesses, but it's actually capital investment into the projects themselves. And while we are working towards that goal, a good kind of interim solution that works for now is to say, okay, I think, maybe my project isn't going to be able to generate the 7-8% returns that investors want to see. So what you can do is go to your buyers, say your carbon credit buyer, and say, hi guys, I've got this project, it's all lined up and ready to go. Would you like to prepay or kind of do a pay-as-you-go arrangement where you fund my project as I deliver it? And then you can get the capital you need to get going. You can combine that with government grants, which are also fairly front-loaded. And that way you can proceed without this external investment for now, and you basically get your buyer to front the money. The downside of that, of course, is that your buyer will expect to have a price locked in forever. And so if the carbon market or the BNG market doubles, triples in price in 10 years' time, then you might be sitting there regretting it. But what you do get is certainty and upfront money from your buyer. So that is the kind of stopgap option, which I think works quite well for now. But to truly get to large-scale investment in the sector, our view is that we need to make this infrastructure project finance model work. And I'm going to stop there.
Yeah, thank you, Tom. And so I know you and Palladium are working on this idea, as you say, of, when the carbon price rises to a certain amount, you want to progress this idea of project finance model, much akin to renewable energy projects. And there are actually a lot of comparisons happening between nature and where renewable energy was 20 years ago. A lot of people are spotting the same sort of structures emerging and the same sort of thinking. So it is good to see. But as you kind of build this concept and you get investors interested, how do you build momentum against that in such an uncertain space where no one knows what the carbon price is going to be in 10-20 years? So how do you galvanize investors to be interested as your project is forming in this uncertain environment?
Yeah, one thing we're working on is working with a carbon consultancy on a kind of forecast of what carbon prices in the UK might do, which I think helps give a bit of more transparency to the market. Mm-hmm. And also, I do think the government subsidies at the moment, they're very good in supporting tree planting. But I mean, there's nowhere near enough money in the pot to pay for all of the tree planting that's set out in the various government strategies. And at some point, I don't think now is the right moment, but at some point in the future, I think there will need to be a conversation around, if we're going to meet this treasury target of getting £1 billion invested into nature every year by 2030. And when we talk about investment, if we really do mean capital investment, upfront money that has to be repaid to the investor, then the government subsidies will need to make room for that. And at the moment, the DEFRA grants, they all come, the vast majority of the grants come in year one of a project. And so you don't really need the investment or very much of it because DEFRA is giving you the money in year one. Whereas in other sectors like renewables, the subsidies, when they are needed, they come at the end, they pay for outcomes. They top up your sales of electricity onto the grid. So they leave the space at the beginning of the project open for investors, and then they top up the outcomes at the end. And you can actually negotiate with developers to get a really good deal for the taxpayer on those subsidies as well. So a couple of things need to change. One is that the private sector needs to start paying more. And the second is that government will need to restructure subsidies to actually make room for real investment in the upfront cost of projects.
Very, very hot topic. No, thank you, Tom. And yeah, thank you again also for calling out the fact that you do not necessarily need investors. You can look at your investment ask and see if buyers can meet that, or other funders can meet that gap. So, and yeah, your point around the trade-off of that, of those two options is a really good one. So I think it's really important, going back to what Simon and Simon covered also, is to know your investment ask in full and really explore other options, which I think every project naturally does as they're building their investment ask. So no, very good point. Thank you so much. And so now we've got our final speaker, Tom Dyke from Triodos Bank, to bring the commercial lending perspective. And I'm really excited to hear about Tom's insight, because he is from Triodos, who has lent against nature-based projects, but he's also a project advisor for projects under development. So, you know, he's got two hats which are relevant to this this webinar today. So, hi Tom, how are you doing?
I'm good, thanks Phoebe, and thanks for the intro. Hopefully you can all see that slide now. I thought I'd just do a very quick introduction in terms of who I am, which I think Phoebe's covered pretty well already, but who Triodos are, which hopefully some of you have already heard of us. But we are an ethical, sustainable bank, and we've been around now for 40 years, and we're founded on the conviction that banking can be a powerful force for good. So our mission is really founded around tackling climate change and social inequality. So as you can imagine, nature-based solutions and funding nature recovery is really very much value and mission aligned for us. In terms of who we are and what we are as a bank, because I think in this session I just wanted to give you a bit of insight, as Phoebe said, from a bank perspective, particularly a commercial lending one. We have a very traditional banking model where we provide retail customers and business customers with current account and saving and investment products. And then on the flip side of our balance sheet, we provide loans to SMEs who are looking to deliver fantastic projects on the ground to deliver a social, cultural, environmental positive impact. And I work in the corporate finance team, which is the advisory team at the bank, and we were set up to ultimately raise risk finance for organisations who perhaps were looking to deliver projects which sat outside the risk appetite of the bank's lending team. And on the screen here, you can see sort of 4 projects, nature-based business models, where we've taken a different role on some of these and provided different product solutions as well. And probably, you know, in terms of what Tom was mentioning there in terms of project finance approach, I'd say the Wire NFM project is most akin to that. Heal Rewilding is really a loan to support an organisation to acquire a piece of land to then rewild on. So very much land acquisition finance there, similar to Oxygen Conservation, albeit both these organisations are looking to leverage in ecosystem services and those ecosystem services being monetized to repay those loans. And then Trees for Life on the Dragon Rewilding Centre, that's a charity bond which we promoted for our crowdfunding platform. And so, I mean, ultimately 4 very different propositions for the bank, and I think probably the next slide will hopefully give a bit of insight in terms of why we're doing all of this as an organisation. We made a commitment to deliver net zero at the latest by 2035. And I think it's important to note that even for an ethical and sustainable bank with a low carbon intensity profile on investments, we have a very big challenge to deliver this on that timeline. So we know we're going to need to collaborate with different organisations and have a dynamic approach as markets evolve. And I think in terms of the challenges we face around achieving that headline objective, which is a top strategic priority for us, there are a couple of factors I think worth considering, which I think these challenges are also very relevant for other stakeholders and hopefully participants on this call, which is first being market maturity ultimately, and that's a comment really about environmental markets as a whole. There's a relatively high degree of uncertainty for investors. Obviously some, such as carbon markets, are more progressive than others, but ultimately for investors assessing those business models, there is a degree of uncertainty which perhaps for some investors they perceive as higher risk as well. The next thing really to say is around business model types. There's a broad range of ecosystem services, and the lack of standardization and contract structures and examples mean that there's a lot of uncertainty for investors also to get their head around there. And nature-based business models can be complex, particularly those where you're dealing with an aggregation model where, you know, suppliers across a broad landscape are involved to deliver the project. And there's also a broad range of funding requirements and a broad range of what's actually being funded on the ground, some of which Tom highlighted in the last presentation. and that impacts what assets are available, potentially for collateral for banks, which is really important as well. Banks, just like other stakeholders, need to invest the time and the resource to get their understanding up to scratch from nature-based business models. And given what I just noted in the first 2 points, there's a lot for financial institutions and all stakeholders to do to increase their knowledge and experience base on these projects. And then the final point, which is obviously very key to this, is project pipeline. There is a growing pipeline of nature recovery projects around the UK, although it's still relatively limited compared to other green finance sectors. Tom mentioned renewable energy there as a prime example, and there's limited examples of those which have already secured private funding. So hopefully we'll see that increase in pipeline where funding support mechanisms which have been established bear fruit on those projects, such as the Natural Environment Investment Readiness Fund and the Landscape Recovery Scheme. You know, clearly a lot of projects underway which hopefully can sort of improve that. So in terms of commercial debt finance, what are the key considerations for project developers when thinking about this potential investment product and this route really for them? I'll start on the opportunity side. I think a key element is retaining control. With bank debt, you aren't selling ultimately shares in an organization and ownership of that organization, and control is not something which that product entails, unlike other investment solutions. The products can be long-term, you know, up to 20 years plus for bank loans. Again, different investors have different expectations around when they want their money repaid. In terms of interest rates, again, bank debt is at the lower end of the risk profile spectrum, so these will be lower than other types of investors in the commercial space. And prepayment is an option. Certain investors want to lock in their returns for a specific period of time because that's ultimately how they've secured that investment, perhaps for a fund structure at the outset. And additionally, banks have commitments, like I've just mentioned on the slide before, to deliver net zero and other nature positive outcomes coming their way, you know, through TNFD, for example. And perhaps that will influence how they structure and deliver their products going forward, by ultimately taking those positive impact outputs into consideration. In terms of the challenges, some of these will probably be well known by certain people in attendance, but banks typically like to have collateral on offer, which they can put a charge against, and a senior charge at that if you're a commercial lender on the high street banking side of things. As I said as well, risk appetite. Banks tend to have a very low risk appetite. They have a fiduciary responsibility with their customers' money, and will take pretty much you know, a low risk approach to their loans. Transaction size as well. Different banks have different requirements around this, but that can be a barrier for certain project developers who are looking to perhaps raise a smaller amount of money. There is an obligation with these loan facilities to pay an interest and capital back on a sort of defined timeline and a defined frequency. Again, during a project's life, you perhaps have the scenario where you have a relatively low cash flow or negative cash flow during the early years of the life as ecosystem services ramp up and ultimately, for example, credits are sold. And the final point on here is around reporting. Banks want management information provided to them on a periodic basis, be it monthly, quarterly, annually. There are different obligations for investees in that regard relative to other investors. So the next slide, what about investor considerations? Well, Triodos and other impact-led investors will first want to understand what the purpose of the project is and its targeted outcomes. But then focusing on the internal processes that they need to go through to prove an investment, what are they really focused on? And fundamentally, big one is credit risk assessment. And that is underpinned by other risk categories, but in essence, it's how likely is it that that institution will get their money back. And I've put some examples here of different categories for project developers to consider. And again, I put this slide in here, hopefully as sort of just a framework to sort of, as I say, highlight the areas that project developers can think of as they're working through their project and going through their investment readiness process to try and get the mindset of what an investor will think about. In terms of delivery risk, I guess, how hard is the project to deliver? Has anyone delivered this type of project before? What expertise does the developer have? What's their track record? These are all things a bank will consider. Financial risk, these are probably fairly obvious ones, but how profitable is the project likely to be? How much do the interventions cost up front? What is that capital cost requirement, which others on the call have noted? And how confident are you in those assumptions which are underpinning that financial model? What contingencies have been factored into that model to show that you've taken a prudent approach? In terms of business and commercial risks, is this a new business model? The likelihood is yes. So that's obviously something for an investor to consider. Is the market established? Are the buyers known? What contract terms do you have in place with those buyers? And how important are those contractual terms? What triggers those payments? Or what ultimately means that they're not obliged to fulfill their end of the commercial agreement? And the final one around operational risk, what resources are required by the organisation? Are they available? How will this impact on project delivery activities? And how long will the project last? And ultimately, investors will want to understand and get confidence in the answers and fundamentally understand the impact of the uncertainty around them. So the final slide here, again, is just kind of a bit of again, looking at that through a slightly different lens, is what information do project developers sort of need to pull together to provide investors and banks with the confidence to ultimately provide them the capital for their project. And hopefully these are areas very familiar for people on the call as they've looked through the other modules from the Investment Readiness Toolkit. But anything around the project background, the origination of the project, the purpose of it, confirmation of legal and regulatory compliance with local and national laws, any permits, licenses that are needed, the environmental social impact of the project, its design, and any initial feasibility and scoping work, financial forecasts, as I've mentioned, stakeholder engagement plans. Ultimately, that's absolutely key to seeing a project be delivered, both on the supplier and the demand side. And then risk assessment and mitigation, as I've mentioned very much on the previous slide, as well as ongoing monitoring and evaluation. So that's a bit of a whistle-stop tour through some of the things that, as I say, project developers and a financial institution will think about in terms of commercial lending.
Brilliant. Thank you so much, Tom. That was a really great snapshot into how banks like Triodos think about approaching nature-based solutions and nature-based investments, and what projects need to be prepared with if they're going to pursue that kind of investor. But I'm just going to ask a very quick question on your other role as a project advisor. And I think reflecting on the different kind of investments we've talked about on this panel, I think one that we've not touched on as much is, venture capital and private equity. So when you're advising projects who are looking at PE, private equity, what kind of considerations do you start them off with? And, maybe a little bit about where do you even find private equity investors who are interested in this space?
Yeah, I think one thing to know, and I think it was noted on the previous presentation, is a project really needs to understand the ask which they have. What are their investment requirements? Is external investment even required? What other structures and solutions are there? Tom mentioned forward purchase contracts for ecosystem services perhaps as a viable solution, and to assess those in the context of, well, what private investment options do I have? Specifically around venture capitalism and private equity, I guess that type of investment has very specific characteristics around it, and typically that's around potential control and influence on a project. Ultimately, those types of investors perhaps are looking to take a stake in the project through ownership, through an equity investment, or perhaps through debt, which has convertible characteristics of it, which then can convert to equity at a later point. But typically, control is a very big consideration, as well as those investors tend to operate at a higher risk, sort of, I guess, appetite end of the market. So their expectations about financial returns could be considerably different to that of a bank, which is ultimately offering a lower interest rate product. In terms of where to find investors, I guess there's opportunities to speak with other people who've developed projects. I think, you know, the ecosystem that you're developing at GFI Hive is a really good example, and hopefully obviously increased database around how other similar practitioners have ultimately engaged with investors. Other advisors in the market to support them, you know, certain types of investors will, you know, that there'll be networks available, but also you might have an advisor who contacts you and connects you with investors in the market. And I guess that's fundamentally my role at Triodos. I mean, a lot of the work I do is around supporting organizations through that whole investment readiness process, really, you know, in terms of I guess the commercialization phase of those projects through to actual capital raising. So yeah, we're an advisor in the market who connects projects with investors, and that's fundamentally what we do. And there's other people in the market who do exactly the same. I think you're on mute.
Sorry. Today. Thank you so much, Tom. Yeah, that's a really good point to raise. And I'll actually just very briefly put a link in the chat of our Nature Finance project directory on the Hive, which Tom, you just made a point around connecting with other projects and exploring what other projects have done. And while there's the NERF SharePoint, which has a very detailed project directory, we're also putting this on the Hive as a public-facing resource to show what innovative nature finance looks like in the UK and whether they're exploring different routes to market. So just a point there around that resource. So thanks so much, Tom, and thanks to all of our panelists. We're now going to open up for a Q&A session, and I think there's already been some comments and questions on the chat and the Q&A function. And just to reiterate, you can raise your hand if you want to speak. I'm pretty sure that's available for everyone, or you can just type your questions in. But I think I'll go to some of the answered questions, actually, because I know that Simon have been getting a couple of questions on the CMI model. So for the purpose of the recording, I'll just read these out. So Rosie asks, are the expectations of returns lower for the CMI approach? And Simon, I know you've typed an answer, but I don't know if you want to come off mute and just elaborate a little bit more for the recording.
I can do. It's more Simon's ball, but basically what I said is yes. Essentially, buyers of the community municipal bonds are expecting lower returns, and the purchase price of a bond can be quite low at about £25, for example, and at the end of, say, the 5-year investment period, buyers of bonds are often given the option of whether they want their return on investment to be paid to them or rolled forward into the project, and so the project can deliver more. And it's one of the benefits of this CMI model, that it's very community focused, and hopefully you know, residents can literally see the benefits and perhaps visit some of the sites that are created, the woodland creation sites. Simon, I don't know whether you want to add.
No, I don't think. I think that's a really good summary. Yeah, absolutely wouldn't add anything to that.
Yeah, no, that's a really good point. And I think someone correct me if I'm wrong, but West Berks had they had a CMI and they didn't monetize. They didn't have the CMI around nature-based solutions, but they had interest repayment. The community investors decided to give back a sum of money from their interest. They just said, no, you know what, we'll donate that. And then they put that money towards, I think it was wildflower planting, or a lovely new site. And so members of the community were very happy to give up their investment interest return for that. So that's a really good example of being where investors can be flexible. Yeah, thank you. And then Jim has asked a question on just again on the CMI approach. Who carries the risk if the project doesn't deliver, and are the community putting capital at risk, or is this underwritten by the council? Don't know if either of you can answer that.
Yeah, I mean, there is a degree of flexibility in how they're set up, but typically the council would carry the kind of the risk of the project not delivering. So they have a requirement to repay a return to the investors. But yeah, in theory, the capital is at risk, but the risk is based on the council not being able to repay rather than the project not being able to repay. So relatively low risk in terms of an investor point of view, investing well. In the majority of councils, you'd like to say that it's a relatively low risk investment because it is disjointed from the actual project itself.
Okay, brilliant. Thank you for that clarification. So Mark asks in the chat, how are likely impacts, positively or negatively, on non-marketed ecosystem services likely to be affected in the CLIS catchment, and what weighting are these given in scheme selection prioritization? It's a bit of a tough one.
Yeah, I think Simon can probably come in on this as well, but I think, yeah, the additional benefits beyond carbon were a real challenge for us. You know, we can clearly identify there are benefits out there, and we went through a process of valuing those benefits, but actually identifying a kind of market that was willing to pay for them was challenging. So the way we looked at it was almost selling carbon credits with kind of quantified additional benefits as in a way to create a premium, a kind of premium carbon unit product, was the way we approached it. But yeah, Simon Bates, I think, going to come in on the kind of the specific kind of additional benefits that are kind of unique to our catchment or not unique to our catchment, I suppose.
One of the big challenges, really, again, it's this issue of finding the market. So, for example, in our CLIS catchment, South West Water don't abstract potable drinking water. So there is, in terms of cleaning up the river, there's much less incentive for action there. Equally, but on the flip side, we looked at things like health and well-being, and with a growing population on the doorstep, that's a really strong driver. But then again, the issue is who's going to invest in that? In theory, the NHS locally might want to invest, but then they're cash strapped. We went to companies like Live West, who are a big social housing provider, and there was a strong incentive, given that they are building communities, building houses. They've got a really strong approach to carbon net zero and for health and well-being. So in theory, there's the potential for them to invest, because you can create woodlands on the doorstep of new homes and benefit residents in that way.
Brilliant. Thank you, Simon. I'm looking at the chat again, and there's a question from Paul here, and I think this is a good question for all panelists, whoever wants to jump in. Is it the case that higher interest rates will make our task a bit harder, having to deliver higher returns? So I don't know if anyone wants to jump in. Tom, I see you nodding your head.
Yes.
Yes. Yeah.
Yeah.
Both Toms. Yeah.
Yeah, quite a lot harder. Yeah.
Yeah, absolutely. I mean, sorry, Tom, I'm cutting across.
No, you go for it.
Yeah, I mean, just to give you an example in terms of typically how a loan product is structured from Triodos or any other commercial bank is you have a margin amount, which is based on effectively the internal view and perception of specifically that organization or project's risk, and that's typically got a sector set of parameters dealing with it. So that's a component, the margin, and then you have base rates on top, or a similar metric, which gives you then in aggregate your interest rate. And considering interest rates have moved rapidly up to 5%, that ultimately creates a much more significant financial hurdle for the projects to deliver against. And again, that's at the lower end of the risk spectrum, really, for investors. So ultimately that will flow through the market, and you can imagine the differential is still going to be pretty similar between bank debt and perhaps, you know, mezzanine debt or convertible loans, which will be double digits. I mean, again, it flows through the whole investment space.
Yeah, absolutely. And I'm just going to add a quick point on that. Tom, you mentioned the wire in your presentation.
Yes.
And
Yep.
I was speaking with the project developers the other day who noted very happily that the buyers had committed to inflation-linked payments. So
Yes.
when this completely unforeseen, or most people didn't foresee this very hostile interest environment that we now have with, you know, with higher interest rates, but there was a panic in the wire for a brief moment to say, oh God, how is this going to affect us? But because they linked their buyer payments to inflation, that has safeguarded them across repayments to their investors and their cost inflations and everything. So I think that's a really good point to bring up. Inflation.
Yeah, absolutely. It's something which, again, I think a lot of people on this call will be all too familiar with in terms of the impacts of inflation and you know, from experience in other sectors such as renewable energy, making sure that ultimately you've embedded that mechanism. If it's on your cost basis, then you need to ensure that your revenue model and your top line is ultimately matched to it in terms of the impacts of inflation. So that's something we were keen to secure with the buyers effectively on that project, and likewise the landowners benefit from that in their contract structures, because ultimately they're hosting and maintaining those interventions on their own land for a long period of time, so their payments are inflation linked as well. In terms of actually the interest rate, which is, I guess they are slightly connected, albeit that's clearly different. That project locked in at a you know, at the time, relatively now low sort of interest rate, you know, was 6%, the potential for certain investors to be reduced down to 5% if certain biodiversity targets were met. So again, you know, timing makes a big difference on that. If we were doing the wire in this environment, the revenue model clearly would be put under significant pressure considering the massive uptick in base rates.
Yeah, absolutely. So just conscious of time, we've got another question in the Q&A from Rowena, who says, who asks, what is the process to feed in projects to the Triodos pipeline? Are there templates, OBC forms? I'm not sure what OBC stands for, or another process to feed in potential projects? So that's to you, Tom.
Yeah, good question. In terms of specific templates for nature-based projects, I don't know. We do have those. I mean, our typical contact inquiry lines are the same for these projects. So in terms of getting in touch with our contact center or a relationship manager on the business lending side of things, and then really taking it from there. I mean, we tend to try and have a flexible approach for projects because projects contact us at different stages and have different, so I guess, information in different formats. But I think that's something for us to take away and think about. On the corporate finance side of things, we've tried to simplify that process for our crowdfunding platform, having sort of template forms for people to fill in and you know, specific questions to ask around the revenue model, governance structure, and a business plan. But no, that's something for us to think about, because I appreciate there are some specifics here, unlike other sectors, which would be useful to cover in a template.
Yeah, no, brilliant. Thank you, Tom. And I'm just seeing, delighted actually to see in the chat there's almost a debate going on, or a topic of, you know, who actually should pay, and, you know, almost like a question on market ethics of the demand for more private finance sounds like a lot like the politics of big society rather than payment for publicly beneficial interventions and tax revenues. So there's this debate going on of whether we should, you know, fund this sort of stuff with tax, or we should increase environmental regulation and policy, and where private investment fits into that equation specifically. So I would just like to clarify that I think there's no one silver bullet to any of this, and I think it's got to be a combination, you know, of the society and the economy we live in and how that's structured. I think all three of those aspects have a role to play. But Tom, I see you've got your hand up, and I think this would be an excellent point to finish on, because I love a debate on market ethics.
Yeah, I think there's a couple of risks with bringing in a lot of private capital to pay for the upfront costs of projects. One is that you drop your standards basically to generate more quick returns early on, so that you can repay the investor. And so maybe you plant a poorer quality woodland or something, or you kind of cut corners. And so I think it's really important that we have really strong environmental standards that are upheld for these projects through things like the Woodland Carbon Code, or maybe the project developers set them themselves. Ideally, it would just be government that sets the standard. So that, I think we need to have really strong standards. And then secondly, I think the other risk with bringing in private capital to pay for public goods is that you could get something a bit like the old PFI scheme under New Labour, where investors were paying for hospitals and things up front, and then in the end, it was all paid back by government, who paid a much higher bill in the end, because they had to pay not only for all of the cost of the hospital, but also pay the return to the investors. So it needs to work out as a better deal for the taxpayer, not a worse deal. And so how do we get better value for money for the taxpayer by bringing in this government money? Ultimately, it means the market needs to pay more to make it balance out, and or the cost of projects needs to drop. And I think an example of where this has worked really well is renewables in the UK. And Bayes did set a very good subsidy model for doing that. And I think DEFRA could learn quite a lot from how the government supported renewables. Yeah.
No, brilliant. I think that's an excellent point to finish on. I'm aware we're 2 minutes over, but I think that was a really good question to finish up with. So all that's left for me to do is thank everyone for coming to our Lunch and Learn webinar, and thank you to our amazing panelists for sharing their thoughts and experiences. And thank you to all of our attendees for joining. And I hope everyone learned something. I hope everyone took away some interesting points from our panelists. And just to flag, our next webinar on contracts development, which is seen by some as a less interesting topic, but really, really important when you get to that stage. That webinar is going to be hosted next month, I believe, on the 24th of August. So I've just posted the link in the chat, and I want to thank everyone again for sticking on for an extra 3 minutes to finish the webinar. So yes, have a great day, everyone.